Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi, everyone.
Thanks for joining us, and welcome to 2025. Happy New Year.
Happy New Year.
Happy New Year.
Excited to be back. So we had a really good break over December.
Yep.
Where'd you go?
Singapore.
You didn't go anywhere?
We just came back from the Perth trip.
Oh, yeah.
And after that, we've been staying in Singapore.
I was in Japan. Half
I
of
was in
Singapore was in
Bangkok.
Japan. You're in Bangkok. So we had a really good break, and we wanted to, just wind down last year, and then now we're gonna get, get the ball rolling again. And usually when we start the year, we want to have a look at the major markets that we look at.
Yeah.
So mainly the US and the Hang Seng and Singapore.
Yep.
What the valuations are and what we kind of want to look out for in 2025. We're not going to make any predictions because we can't do that.
Yeah.
Yep.
But we want to see where we are now and what could possibly happen. So why don't we start with the US market?
Yeah, so I think if you look at the US market, generally the valuations are still at all-time high. If you take the last 10 years and then we measure it against the S&P 500, the components, companies that made up the S&P 500, and we use a PE ratio, you can see that on the charts over here, we get to see that they are trading at above the both 5 years and 10-year average. Okay, so right now, I think S&P 500 is very close to around 30 times, while the 5 years average is about 23, and then the 10 years average is about 25. So you can see that the S&P, it's actually almost the level that we have seen last seen, I think, in 2021. And that's right before the crash. Okay, but that doesn't mean that US is going to crash, right? The reason why for the high valuations is also because I think US economy is doing pretty well, right? And the underlying S&P 500 companies, I think generally the market is expecting them to continue to grow, especially the Magnificent Seven, and that's the reason why valuation is looking on the bright side. Okay, so this is where I think US is currently right now. And so things are generally more expensive. So if you're trying to invest in the US market in 2025 this year, right, it's going to be a lot harder to find ideas, right? So generally we are also taking more conservative approach where we are not as aggressive as we used to be versus 2 years ago or 4 or 5 years ago during the COVID, right? So right now, this year probably we will still continue to be the net seller. I think we have been selling some US stock, paring down some of the shares that we have in the US. So this is for US market. So I think Trump is going to get sworn in as a president on the 20th of January, which is going to be next week. Okay, so once he got sworn into the office, a lot of people are looking into whether there's going to be a intense trade war happening, because before he won the election, he already promised that he's going to increase the tariff against China to up to 60%, which is very crazy. And not just China, he's also going to, I think, impose tariff on Canada, Mexico, right? Because they have a trade deficit with those countries, right? So any country that have trade deficit with US, I think US or Trump is likely going to go after them.
Okay.
Right? And that's where he's going to impose that tariff. Okay, this is not good for businesses that might be affected, where their raw material got imported into the US, and that area might get affected. Yeah.
All right. So that means these companies, if they can't pass down these price increases to the consumer, it's going to affect them, because then profits are going to go down. But for companies that have pricing power, like you mentioned before, companies that can do that, that's okay.
Yeah, or even I think software-based business, generally you don't have raw material, right? So I don't think those areas will be affected. So I think your Magnificent Seven have for example, your Facebook, your Google, and these are all software-based type of businesses.
But Apple could be affected in this sense.
Apple could be affected because a lot of their products are actually manufactured in China. So unless they can get a tariff exemption again that they did in the past, but in 2024 or 2025, we don't know whether they can get another exemption from the Trump administration to get the exemption for that.
Okay, so tariffs are one thing.
So I just got another table that I tabulate for the US valuation. So I tabulated in the 1973, all those peak before they start crashing down. So 1973 was the Nifty 50 crash. Then was 2000, the tech bubble, and 2007 was the global financial crisis, the peak before that. So I got the current run here over here. So you can see that in 1973, the P ratio at the point of time was about 18.09 times. 2000 was 28 times. 2007 was 20 times. And right now, currently, we are about 30 times for our this valuation. It's not depressed earning, but really growing earnings, right? So the expectation is very, very high now. So there's this thing that we call the earnings yield, right? So earnings yield is the inverter of all these P. So you just take 1 divided by 18.09 and you will get the earnings yield and multiply 100%. So the earnings yield of 1973 was about 5.52%. And usually what Buffett says, you always have to compare with the bonds, right? So does it make sense to invest in the bonds or the thing? So at the point of time, the US Treasury yield was about 6.46%. So actually the safe bonds is traded much higher than the earning yield of the S&P 500 at the
So you're
point of
saying
time.
that the yield from the bonds was higher
Yes, correct.
than the stocks?
Yeah, so the difference is like negative 0.94%.
Okay.
Yeah. So for 2000, it was also higher at the peak, right? The yield was, the 10 years treasury yield was about 6.05%, but the earning yield was 3.56. Right. The only one that have the positive figure is the 2007, where the earnings yield was 4.83, but the 10 years treasury yield was 4.53, but it's very close, right? So the difference is only plus 0.3%. Okay, so right now what we are experiencing is that the earnings yield is about 3.27 and the 10 years treasury is about 4.62.
Okay.
So the safe bonds is much higher than the earnings yield right now, right? So it does reflect that the valuation is very high, but of course we are not saying that you sell everything off, right? We are just telling you to be more prudent when you start to deploy your money into the US market. So let's say you have not invest in the US market before, you are 100% cash, it should be like maybe 10 or 20%. Okay, but if you have already invested substantial amount, then I think now is a good time where you continue to build up cash and wait for opportunity before you redeploy inside the US market. And of course, we also need to understand that bull market can run a very long time. Right. So now it's high, but it can get higher because of emotions, investor sentiments, and all this. So you never know when is the peak. Okay, but we will know where are we right now. I mean, it's like is people are getting more aggressive in the market. Right. People are happy in the market. That's where you need to be more conservative and deploy only when is depressed,
depressed, or there's a pullback, right? So pullback could be like you see a S&P corrected by more than 15% from the peak. That could be one good re-entry point for a lot of you guys. And of course, my take is that you may not need to fully cash out also, right? Because even though US is expensive, it should not try to time the market, because it's really impossible to time the market. And the fact that why the valuations is high, like I said, it's because the underlying earnings from these S&P 500 companies, I think it's still very solid, especially the Magnificent Seven, where they have growth from the AI, right? Artificial intelligence spending. Okay, so stay invested in good quality companies and don't try to time the market. Obviously, you can always pare down some of the position that you think is like overvalued, right? And then beef up your cash position, but again, don't fully exit the market.
All right. Yeah, so this is in the US market. We mentioned tariffs. Is there anything else that you look out for in the US?
So another point that to look out, of course, is the announcement by Trump where he's going to cut the corporate rate tax. Right? This is a net benefit for a lot of US company if he really reduce the corporate rate tax from 21% to 15%. Right, then you're going to see a lot of growth, right, from S&P 500 companies, even though they may not experience absolute growth in their net profit, but because of the tax saving, they can really enjoy that growth in terms of earning per share, right? So that part will again justify why US is currently trading at a high valuation right now. So there's a one-time boost for a lot of US company in 2025, and the other things, of course, Fed is likely going to continue to cut rate, but this time around 2025, I think a lot of market participants are expecting that their rate cut could be a lot slower, or it could be the same if, let's say, inflation were to go up, because of the Trump tariff, mass deportation of migrant workers, right? So all this could potentially, cause the inflation to stay high, right? So this is where it really depends. Everyone is looking whether the rate is going to continue to drop. But this time around, I think everyone is kind of like agree that the rate is going to drop a lot slower versus before Trump got elected as a president.
Okay, so that's interest rates and inflation, and that's pretty much it for the US market, right? It's a little bit expensive. I think the earnings yield is a good point, because if the bonds are giving you a higher yield compared to equity
and risk-free,
it makes sense to move your your capital into that asset class. So that gives you an indicator. What's one indicator? You can't predict things, but it's one indicator that stocks are expensive. Yeah. So like you say, look for opportunities that make sense in terms of valuation, but if not, you're just going to wait.
But of course, there's still undervalued company right now in the US. Right? It's just that whether there's a lot or there's little only. That's all only, right? So at this current moment, there is still, but the opportunity is much less.
Okay. All right. So that's in the US. Let's move on to the next major market that we look at, which is the Hang Seng.
So if you look at the Hang Seng, I think I plot the PE chart over here, the 10 years PE. So right now it's still traded below the 10 years PE chart. So previously, I think there's a slight run up in the Hang Seng index last year, right? So that goes to the average, but after that, I think the run just died down and it came back down again. So right now, I think it's still around the 10 times. It's quite cheap for the Hang Seng index. And if you look at the Hang Seng is very tied to China. So if you look at the China government has been doing the initiative, the Hong Kong government has been doing the initiative to revive the property market and all this. I think moving forward is more net positive than net negative for the Hang Seng index.
Actually, if you look at the news, China government, they write the title vows. They made so many vows to revive the consumption growth, vows to revive the property, vows to revive.
That could be just the editor of the newspaper.
That could be the editor. So it's such a strong word, right? But I think if you look at the announcement late last year, I think they've seen that they have released the reserve ratio requirement for the bank. They are pumping in money into the stock market. They're also relaxing a lot of cooling measures that they've done with the property market in China. So I think there's a lot of initiative that the government is actually they are very committed to really revive the whole economy, right? Because now the consumer sentiments are really on the fragile state. So they wouldn't make that kind of news that they did during like 2022 or 2021 where they want to do another crackdown on certain industry, right? I mean, corruption is something that they continue to do, all right? And that's something that will be ongoing for every years. But you can see that their tones really changed, since last couple of years, right?
I need to clarify. Crack down on corruption is something they're all still gonna do.
Yes.
Not corruption is all you're gonna do. Just to be clear.
Yes.
Crack down on corruption.
Yeah.
Okay.
So and they're gonna keep loose policies on. So that also means that the interest rate likely going to stay low in China, all right? And when you have a low interest rate environment, obviously the consumers will think that the money they put in the bank earning at such a low rate, they might be encouraged to spend, right? So although Chinese are such a great saver, right? They just want to save money, right? But I think government is really trying to push all the way out to make sure that the consumers really spend, right? And China also have that inflation issue where the inflation rate in China is really on the low side, 0.2%. Sometimes it goes into the negative territory. That was I think in late 2023. But has been less than 1%, which can be a problem, right, for countries like China. So they need to make sure that inflation stay at like 2%, 3%, which I think all countries like US also, they want to achieve that kind of like 2% average rate, right? So that's why they are trying to boost that consumption, and eventually I believe they can do it because they have that full control power over there. Right, so this is something that we will continue to look forward for Chinese market and what the government is trying to do to boost the sentiment, not just in property, but also in the stock market as well.
Okay.
Yep. So I plot the 38 years year-to-year returns of Hang Seng Index from 1987 to 2024. So that's about 38 years. So if you look over here, right, most of the time they have 1 year down and they just start to recover and all this, right? There's only one instance where they consecutive 3 years down, which is the 2000, 2001, 2002. They consistently down for 3 years, right? And because of the tech bubbles and the Asian financial crisis, so that happens to them. 2020 onwards, right, that was where they broke a new record. They consecutive 4 years is down, right? The past track record was 3, but most of the time it's like 1 or 2. So if you look 2000 to 2023, right, they are consecutively down like 3.4%, 14%, 15%, 13% on a consecutive years. And of course, with the government, like we can say vow initiative and all this, 2024 was actually a positive year. So that's like 17.67. So I think based on, if you look at the statistics and all this and what the government is doing, right, I think moving forward, I think it's more of a positive outcome for and the valuation is cheap also. I think there's more reward than risk moving forward for Hang Seng.
So you think in probability, you think Hang Seng is going to have a better year?
Performance.
As a performance, rather than another down year.
Yeah. So I also cannot really predict the thing, right? Because if 2020 to 2023 they can consecutively down 4 years and breaking the previous record, right? Was because of that was a government induced crackdown that causes this issue.
Was it COVID?
It was COVID, and also the government induced that happens, right? Because actually the Chinese company actually run up during COVID because they are doing very well. Then when the government induced all these regulatory, that's where the earnings start to drop. Okay, but now the government pull back on the regulatory, so I think the outlook seems more positive than negative, lah. That's what I'm trying to say.
And starting from a lower, less expectations and all that stuff.
And 2024 is a positive year.
Okay.
Right. Yeah.
And obviously, of course, we are not trying to try to time where China is going. This is our macro situation that is very difficult to predict. There are so many moving parts. But I think what we can do as an investor is really select those companies that are high in quality, right? And they are still doing well despite the slowdown in China, right? And those companies that they are still, if you look at their result, they are still enjoying earning growth, revenue growth, although it not be the double-digit kind of growth, but the earning growth is like double-digit, 20-30%. These are high-quality companies that continue to do very well in distressed situations like now in China, and their valuations are cheap, right? So you want to stay invested in this company, and when times are good, consumer spending start to come back. They manage to revive the whole economy. I think this company will deserve a premium valuation.
And also make sure that the company you look at is also majority business is domestic one.
This is very important.
Because of now it's a lot of this trade wars, right? So we have to really buy into countries where it's within their own country first, then the export or import is a secondary thing.
All right. So you want, if you're looking at Chinese companies, strong Chinese local consumption.
At least 90%, 95%, or revenue derived from China.
Okay. Yeah. So that's for Hang Seng. So you look at very specific companies within the market. So let's look at our home market, Singapore.
Okay. So Singapore market, if you look at the price to book, I'm using price to book as usual. Why I say is because a lot of the companies still in the old asset, like there are banks and all this which hold 50%, okay? But a lot of their business are changing to asset-like models already. So right now you see if the price to book is just traded above the average, right? But actual fact, right, it may seems like it's slightly premium. But because of the initiative that a lot of the STI component companies are doing right now moving forward, right, turning into asset-like model, right, the PB ratio, right, should trade at a higher multiples. So the current average, right, I believe, right, moving forward, the next 10 years should be moving upwards one, instead of maintaining at the same average. So to me, I think it in general the STI is I think it's generally fair for them, right, at this valuation.
But what I'm actually very bullish in Singapore is of course the REITs, everyone's favorite, right? The valuation for REITs across the board had fallen, right, since Trump got elected, and then there was a talk where the interest rate might no longer drop as much as what people are actually expecting, and because of that, REITs prices across the board have actually been sold.
So they went back down. I mean, there was a rally, and then
there was a rally.
It just went back down.
It just went back down again. And today, as the start of the year, I think the valuation for REITs in Singapore, all right, really attractive, right? So for investors who have missed out REITs last year or like many years ago, all right, this year is really a good time to relook at REITs again, okay, because the valuation have fallen, and of course the rate unlikely going to go up, all right, either stay the same or it might go down. I don't know, I could be wrong, but what you want to do is, of course, again, back to the fundamental, find those high quality REITs, those landlords that can actually have been increasing the rent, okay, because they have like advantage. So for example, CICT, Capital Integrated Commercial Trust, right? I mean, they have a huge exposure in office, grade A in Singapore, all right? And currently grade A offices in Singapore is experiencing a tightness in occupancy, right? So supply so very and it's a landlord market. Generally, if you are renting a space in CBD area in Singapore, obviously the landlord said this price, you can't really negotiate that much, right? You have to accept it. Otherwise, you can't find any more new office space. So that actually is very favorable for landlords. So office REITs that have a large exposure in Singapore market like CICT would benefit because they can increase the rent, right? And of course, with the funding cost now is actually more or less stabilized. And if there's a potential further rate cut right down the road, of this potential rate cut will be turned into a saving, and that will again flow directly into your distribution per unit. So this is a kind of situation that I usually like because the valuations is depressed. At the same time, there's a catalyst, right? Potential rate cut, further rate cut, which we don't know, right? Or they actually have been doing it, the rate increment, the rental increment with their tenants, and this will flow in for the next, or actually been happening last year, and then they will start to flow in again more this year, next year. So potentially these are the companies that, or REITs that you really want to find, high quality one. Of course, I'm not asking you to look at those like don't have bargaining power or it's a tenants market, right? So find those good one. And then for me, is we just park the money there, get paid, while wait for the market to recover.
Yeah, I think if you point out a quality REIT like CICT, for example, I think the yield right now is above 6%.
Yep.
Thereabouts. Yeah.
Thereabout, huh?
So, I mean, if you're looking at REITs, you like the yield that they give. It's a great time to have a look at it.
Yeah.
I mean, again, no recommendation to buy or sell anything. Again, with all the US, the things we talk about, the US or Hang Seng or Singapore REITs, we're not making any predictions. But like you said, in this particular market, the whole market has come down because of like macro events, the interest rates, REITs have come down. But you're going to find opportunities there because there's so many high quality REITs that you can look at, which are giving good yields, low vacancy rates.
So just a minor correction also on my side. CICT is about 5.4% yield.
5.4%.
Yeah. So even then, it's like actually above 5% is really considered quite attractive for a stable REITs. Again, it's not a recommendation to buy or sell. I'm just highlighting example because sometimes people say you never give example. You're just saying general things, right? So it's good to give example, but don't take it as a recommendation to buy.
I mean, if you compare back to the what's that thing called? The 6 month T-bills.
T-bills.
Your 10 years SSB
3%
is still higher than that, right?
Yeah.
So it's again looking at the opportunity cost of your own country, right? Because US, I use US one.
So again, of course, we bring up this example because we are very familiar with the REITs. If you are not familiar, go and study them, right? And then learn more about them. Very important.
All right. So I think we're going to be covering REITs quite a bit this year because I think it's it's like you said, quite a lot of opportunities there. We're not going to cover it in this roundtable because we don't have the time to go through all the things that we're looking at. But we're definitely going to talk more about REITs, Singapore REITs specifically, in upcoming roundtables. So look out for that, and do subscribe if you're interested in that. And we're going to see what we can pick out from that market. What's giving good yield, very high quality. We're going to talk about that.
Hi guys, we're going to be having our upcoming webinar on the 16th of Jan on how to invest your CPF money. So if you are interested, please go to fifthperson.com/CPF and I will see you there.
All right. So anything else you want to talk about Singapore at this time?
I think the thing about Singapore banks is last year a lot of people asking me when should we sell the banks, right? I mean, I already say this again, the opportunity cost between the bank yield compared with the SSB, your treasury. So right now they are still at high end, and I will say that the interest rate is not going to unless going back to 0% or 1%, then you can see a very big significant effect to the banks. Even though the yield is high, right, but the valuation for the banks is, I think, it's more on the high side, right? So I even though I say that we don't sell the banks, right, because of the opportunity, but I feel it's also not a good time to look into the banks right now because of the high price to book valuation they are in right now. With some of the banks, like maybe you look at DBS, I think it's traded already close to 2 times books. That's quite high on their side, right? Even though the yield are going up, but I think at a higher interest rate environment or long term, like 3-4% interest rate, right, the bank's book value tends to trade at a very high multiple, and they can go higher than 2 times one. If you look at the past track record back in, I think, 2007 or back in the 1990 something, right? So I think still have to tread with cautious when investing in banks, because the banks is very sensitive to interest rate, so they'll move up and down. So you based on the opportunity and look at them.
Okay. All right. So it's pretty much it for Singapore.
Yep.
Yeah,
Alright.
and don't forget to change the new notes.
Chinese New Year's coming up. Okay. So you still give ang pao using notes, or you
Yeah, I
just kind
think
of like use
it's
PayNow nowadays?
no,
give
no,
notes
no,
lah.
no, give notes better. Yeah.
But sometimes I don't see someone. I just say I'm going to send you the money.
Huh.
Yeah.
If I don't see someone, I don't give it to you.
Oh really? Okay. So yeah, it's quite. Some people like kind of paying out the ang paos as well. Okay. So anyway, this is what we wanted to share. Welcome to 2025. Is one whole year of investing to look forward to.
Yep.
Yeah.
I think there's some really interesting opportunities, especially in REITs, in Singapore REITs. We're going to cover that again. We're going to watch the banks as well.
Correct.
Really
We'll keep a close eye on it.
Yeah, so stay tuned to our channel because we'll be talking about this throughout the year. Things are going to happen. It's very dynamic in the world of investing. But once again, we're happy to be back. So welcome to 25. Thank you for joining us today. So my name is Adam. Rusmin. Victor.
Thank you.
Any questions, you want to put them in the comment section, we'll answer them for you. Of course, please hit the like button if you like this roundtable and subscribe to our channel. Many more roundtables coming up, and we'll see you again.